Hi guys, it's Henry from Investment for Expats. And today go over a topic that I get emailed in quite a bit, and that's IHT tax planning for expats living in Thailand, particularly those that may have Thai wives. So we're going to go over some of the current rates of the IHT as of May 2024. Again, this could change, so be checking up on HMRC for the latest rules and legislations. We're then going to go over some of the options that you have to mitigate inheritance tax and some of the strategies, either gifting or putting in investing. So first going to go over the current rates. As it stands, is 325,000 per single filer, and this does increase to £500,000 if you've got a prime residence. However, this won't be applicable to you if you're living in Thailand. Anything over that amount of £325,000 on your worldwide assets, excluding your UK pension or anything in the trust that we'll get onto later, will be taxed at 40%. So I'm going to go quickly now into a scenario that I've written down. Hypothetically, say you've got investment pot that is worth £1 million, not in your UK pension, not in a trust. Therefore, at the current rate, anything over £325,000 would be subject to tax. So in this scenario, it would be £675,000. This would be the IHT tax liability would be £270,000. Now, as you can see, that's quite a lot that liability to HMRC. So looking at mitigating these ways is quite important. Now, some of the ways to mitigate it is gifting. Gifting has a 7-year rule into it, is where if you gift it from years 1 to 3, it's still taxed at 40%, as you can see at this picture here, and then 4 to 7. You can see it goes down on a sliding basis, 8 years. Some of the pros of this is it can be quite easy to do. Some of the negatives is that you are giving the gift into the beneficiary so they can do what they want with it. It won't be in your name. You don't have control of the assets. And also if it's putting a trust, it can be quite costly. And also you don't know when you're going to die for most people. So it does have that unknown factor in it. As you can see here, they've got discounted gift trusts that are used more commonly, but also in terms of offshore trust, now QNUPs. Now QNUP stands for Qualifying Non-UK Pension Scheme. The benefit of this is it works mainly like a UK-based SIPS, so you can add with it what you want, but you don't have the allowance of say 60,000. It allows for tax-free gross roll-up, and you can invest in different investment vehicles from it. So you can invest in US dollar stocks, funds, etc. So it does have that kind of flexibility for investing as well. From an investment point, I'm going to go on to the investments, what you can do to invest. Now, there is some more obscure investments that you can do, such as forestry, etc., farmland, but we'll leave that for today because I think that's more of a boutique planning. But for your more vanilla planning, what you can do is look at AIM shares. Now, AIM shares are the smaller listed London stock exchange companies. The pros of this is it's quite easy, and there is a number of strategies these days, a number of funds that give you that are aimed specifically at IHT and AIM shares. The cons of this is that they are quite volatile as the smaller listed companies. A lot of them aren't over £1 billion in net worth, so it can be quite volatile. The other option is gilts. Now, this kind of has the opposite end of the spectrum, where if you're looking for high risk, it probably may not go to gilts, especially if the BOE comes down to its 2% inflation target figure. So, but they are two of the investment strategies. I'm going to put a link to this article in the description. So if you have got any questions, feel free to email me or read it on the Investment for Expats website. Yeah.